You might think holding a very large property portfolio in retirement means the pinnacle of wealth creation. But if you've already watched episode 1 and 2 of this 3-part series, you're not going to be surprised when you find out it might not be the be-all and end-all to your wealth creation. In this episode, I'm going to talk with Adam Chalk, financial planner, about what assets the wealthy are holding in their retirement. We're going to be discussing about the breakup of those assets and how to really segment it to make sure that you are getting the best outcome well into your retirement. I love property and I love shares, but this is going to be one of those age-old debates of where your money should be at your retirement or prior to your retirement. I'm looking forward to this episode and sharing with you all the tricks and tips that you need to make sure that you get the best benefit at your retirement. And I'm going to be asking the hard questions to Adam as well, making sure that I try to extract everything that you need to know about a successful retirement. I'm Jeremy Iannuzzelli, and this is what school should have taught you. Let's get cracking into episode number 3.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Adam, thank you very much for joining us with this third and final episode of our 3-part series, sitting down with you, a financial planner, principal planner at Fruition Wealth. This is an opportunity now to really bust some myths and debunk some myths about, only the wealthy people can retire successfully, or you need 10 properties all paid off, returning stupid amounts of money, or properties in your retirement don't add any value and it costs too much money, you should only have shares. So this is just really debunking a lot of myths and really hearing from someone like you who's worked with so many people, especially, for the last 20 years of you in the industry. You work with a lot of people through to their retirement and really structured a lot of their assets for a very healthy retirement. That's while they're working. And then obviously when they're retired, I've worked with you on a number of clients where, they've transitioned really well from working to being fully retired. And I've seen you pivot and really change and strategize their portfolio of assets so that they can comfortably retire without the headaches, which is what we're all after, right? There's no point retiring, but then when you retire, you've got a job where you've got to manage all your assets at the end. So Adam, today is really just discussing with you and really getting a lot of information for the listeners that listen weekly to our YouTube series and our podcast, is about what assets should we be holding at retirement, or what level of diversified assets should we hold at our retirement? Not necessarily going to hold you to a certain ratio because everything's different, but what have you seen work really well over your last 20 years?
Thank you, Jeremy. And mate, thank you for the intro and having me on your podcast, mate. It's a privilege to be here, mate. So you're absolutely correct in your statement that assets need to pivot in retirement. And it's really coming back to what the objective is. So obviously, whilst you're working, accumulation of wealth is generally the key objective. When we pivot to retirement, we're looking at income generation as well as protecting the capital. So with those two key things in mind, one of the things that we can't plan for in retirement are those left field events, a COVID, a global financial crisis, in the mid-80s, the famous recession we had to have. Markets can fall 30, 40, 50%. That has happened, will happen, can happen. So in a retirement portfolio, noting that we can't predict when these things are going to happen, we need a plan to fund liquidity through those periods. We don't want a situation ever where we're selling growth assets at the wrong time. So for example, during COVID, markets fell, 40% in a month. You wouldn't want to be selling your Commonwealth Bank shares at 40% below their current price to fund your retirement needs. So what we do is we create buckets effective, essentially. So the first bucket that we consider is a liquidity bucket. That's going to have cash, term deposits, really capital safe type of assets in it. And that's designed to float you for 12 to 24 months when one of these left field events happen. That way you're not selling any shares, you're not selling any properties, you're not liquidating anything at the wrong time to fund your income needs. Then what we have is sort of like a medium-term bucket. And what this bucket might have is high-quality bonds, fixed interest assets such as, high-grade corporate sort of bonds, And this is designed to ensure your portfolio keeps pace with inflation.
So you just said bonds. I'm sorry to track back you on that. A lot of people listening may not know what a bond is. Can you just give it 5-second, 10-second wrap up of what a bond is?
I guess the most common one that we talk about, or it's in the media, is a government bond as an example. So as you know, governments run deficits, and how they can fund that deficit, one of the methods is through a bond issuance. So it's basically just saying, hey, Jeremy, will you lend me $100 for 5 years, and I'll give you your $100 back in 5 years' time, and along the way pay you some interest. So there's all different terms with respect to bonds, different, what we call, interest rates, but essentially it's a debt instrument. You're lending money to the government or an institution, and they're promising to pay you back that money.
So it's almost like money in the bank, but it's kind of locked up for that period of time, although you can sell it, but you may win or may lose depending on who buys that portion of bond remaining from you. Is that right?
Absolutely. And it's generally deemed, depending on the type of bond, but generally a safe asset. Like if you're lending money to the Australian government, for you to lose your money, you need the government to basically go broke. So the likelihood of that happening is extremely, extremely low. So they're deemed, particularly that top end of bonds is deemed quite safe.
Beautiful, beautiful. So anyone out there, maybe if you're looking at buying bonds, your Cuba, your Venezuelas, they might be a little bit off your radar. But if you're looking at, big governments, safe governments like Australia, then, you're pretty safe. There's always risk, but you're pretty safe.
Correct. And so we like to have them in that sort of second bucket, that sort of, they're going to get you a better return than cash, but they're still quite defensive style assets. And then the third bucket is our growth engine. We might have our shares, our property in there, and that's really going to drive a portfolio. So we've got our sort of liquidity bucket, which is there for funding short-term sort of liquidity needs. We've got our medium-term bucket, which is a defensive bucket of assets, which is making sure we keep pace with inflation and paying some income into that sort of bottom bucket. And then we've got our growth engine, our sort of property shares and growth assets, which have a 7+ year sort of time frame on them. So that way a COVID-2 happens, not that I don't think they'd ever dare to lock us down again, but if something like that happened, that you continue living your retirement as you like because you've got your short-term needs funded through these sort of asset buckets.
So if we talk about, say, the size of those buckets now, we'll just break it down if you can to a percentage. I think that's a really good way to represent it. If we're talking our short, medium and long term, what would you have as a percentage of someone's overall portfolio? Now, I know it's very different for many other people, but if you had to kind of generalize a percentage, what would you consider the percentage for those three different buckets to be?
Really good question. So we really reverse engineer it around the income. So let's assume a client has a $2 million portfolio and they want $100,000 a year as a passive income, which is about 5% of that account. So normally what we like to have is, let's call it 2 years in highly liquid assets, so that bottom bucket. So that would be $200,000 or 10% of the portfolio. Mm-hmm. Then what we like to do is have another 3 to 4 years in that middle defensive bucket. So we added another 400,000 to that sort of middle bucket. So that's,
another 20%, say, 20%. Give or take.
Yep. So we've got 20% in the defensive bucket. We've got 20% 10% in the liquidity bucket. So then the remaining, 60% of the portfolio generally will be in that growth engine. So a 60-40 type of split between growth assets and defensive assets, depending on the amount of income needed. But in that example, we want to have sufficient income to meet any short-term sort of debts. We want to have that defensive bucket accounting for another 2 to 3 years of income needs, and then a growth engine for the remaining funds.
See, I think that's brilliant, because I could probably honestly say not many people, and again I speak to so many people on a daily basis, not many people are segregating their assets on a, I need this amount of money for the next couple of years, so I don't need to sell any assets in a downturn. I need this much money over the next, say, 5 years, and then the balance of it, because it's a little bit far down the track, I can afford to go through different cycles. What I typically see, Adam, is people concentrated into one specific asset base. And I'm probably a little bit guilty of it myself. A large portion of my wealth sits with inside property, and property would be considered in most circumstances a very illiquid asset, although, it tends to hold its value I believe, in my opinion, are much better than many other assets. It's definitely not as volatile as, say, cryptocurrency. So, but if I needed that money very quickly, I'm kind of relying on the market. I would have to sell that asset, take 12 weeks to potentially do it, and then I'm very reliant on market movements. So I think that's very important. When you're listening to this, you're listening to how much money do I need for a couple of years? How much money do I need for, say, 2 to 5 years? And then the other portion, the leftover balance, it can be situated in those longer term, more growth focused assets. Adam, what do you see from a lot of people that are coming to you, say, later on in life, wanting to get a bit of a retirement plan? And just again to, I suppose, for people to really say, yeah, that's me. You know, there's no late or too early time to do it. What are you tending to see people have towards the later stages of their retirement who you've just met, essentially wanting a retirement plan?
So someone will come to me generally because super's been compulsory for decades now, with 1.5 million, let's call it in an industry fund, balanced fund, and say an investment property. Now, what we want to look at in our structuring is, for example, looking at this industry fund in isolation. There's nothing wrong with them whilst you're accumulating assets. They're cheap, everything's pooled, they perform well. So I don't want to, for a second, come across as an industry fund basher. We like them, we use them where appropriate. But in retirement, having all your assets or the bulk of your wealth in a balanced option, so to speak, can be quite dangerous, because when the market falls, your return is falling, holistically in that fund. And if you're drawing money out during that fall, you are selling assets at the wrong time, which is what we want to protect against. You're selling assets during that fall to fund your pension payment. So generally we might look at a restructure of that industry fund to have those buckets that we spoke about. Like, well, let's not have 100% of money in a balanced fund. Let's have that liquidity sort of investment in there. Let's have that medium-term investment in there, and then we're going to have a long-term growth engine. So we might look at a restructure within super to tick those boxes to ensure that we're not selling assets during the downturns at the wrong time. Then we'll look at the property. And as you know, property, I love it as a wealth accumulation asset. A residential property generally may not be the best retirement asset. By that I mean, let's say it's worth $1 million. Once you take out agent fees, costs, maintenance costs, insurance, you might be getting 3.5% yield out of that property. What you make your money is on the capital growth. But in retirement, if it goes from 1 million to 1.2, does that really help you? You can't tap into that equity. So if the objective is income, we really want to look at, one, how much assets you have outside that property to meet your income needs. Two, is that property going to serve you in ticking your income objective in retirement? And the numbers will tell us that story. And I'm sure, Jez, you see a lot of, property concentrated portfolios that don't necessarily align to those income objectives in retirement.
Yeah, well, I think that's an important point you touched upon. So the property could form part of that 60% allocation to growth if you've got your bucket 1 and 2 down pat, ready to go. So you have your couple years worth of liquidity, low volatility, essentially cash there, and then you've got your 2 to 5 year bucket. I see very typically, especially along my clients, is they're very heavy in property. Again, nothing wrong with it when they've got their cash cow, whether it's their business or their employment. But you often hear about this concept called asset rich, cash flow poor. And I see it. I see it on a daily basis. People heading into their retirement, they've got $5 million worth of property, Adam, but they're only really generating 10, 20, 30, 50, maybe 40 grand worth of net rental income because they've got land tax, which is an absolute killer. But one of the big things that many people forget is that residential property and property in general, not so much with commercial, more so with residential, but I'll paint all properties with the same brush in this particular comment, is that properties require repairs and maintenance over the longer term. There's no property that you can leave for 50 years and it just doesn't require a new kitchen, plumbing, liquor, paint, flooring, maybe other issues. So you've also got to factor that in, especially at retirement, that it may need a new roof, it may need a new kitchen. Tenants may have destroyed it and the insurance policy for landlord hasn't kicked in. So that can be quite destroying to a lot of people's retirement, especially when these events occur, these $30,000, $40,000, $50,000, $60,000, $70,000 events. And people don't often have the cash. And that's where I'm seeing them, Adam, having to sell down good growth assets in potentially a low income generating or low growth generating environment. So it's very important that use the right assets at the right time to accumulate wealth. And then when you're heading towards that retirement or close to retirement or at retirement, make sure you're thinking about what Adam said, which is segregating your wealth into those different buckets, those short, medium and long-term buckets, making sure that you've got the right assets in those buckets, because you don't want to be putting a property which is not providing a lot of cash flow that has potentially higher costs longer term into a short-term bucket, because it's not going to serve its purpose. And making sure that you're looking at the right type of asset. And Adam mentioned things like bonds. Yes, property, shares, managed funds, things that really suit that specialisation of the percentage that's required for those three separate buckets for your retirement. Adam, I thoroughly appreciate your time, mate, going through that in detail with us today. I think it's been brilliant. I know there's so much more that we can discuss about what type of assets the wealthy are using. We can pinpoint down to the specific investment or the specific area, the specific sector. But what I wanted to get from you today is that people really need to start thinking about the segregation of their assets at retirement, how they should be funding their retirement, how they need to split up their income needs of their retirement, not necessarily focusing that property or residential property might be the only thing that we can utilise, not necessarily thinking about shares is the only thing to utilise, but a suite of investments that kind of fit in those three separate categories. On your end, Adam, is there, I suppose, any pressing points or last comments that you would like to make about the type of assets that are required from a retirement perspective? Because I know we could talk about it all day, but if you could leave us with a couple of action points on your end, things that we can really think about now to make sure that we're getting that right asset allocation almost on track, ready for a retirement perspective. And these are for the people that are probably more towards the retirement age or may have their last 5 years of their working career ahead of them. What action points can you leave them with?
Well, two key things. And again, as you know, we're very pro-property, so I'm not bashing property by any respect. But one thing that I find with retirees who have large property portfolios, just make sure the assets are serving you and you're not serving the assets. By that I mean, they might be 75, late 70s, and they've got half a dozen properties. And then it becomes a headache because, like you rightly point out, there's a tenant putting holes in the wall, this one needs maintenance, and they just don't want to deal with it anymore. So just make sure that as you're heading through retirement and towards retirement, you're also factoring in that administration and the energy required to run your portfolio. Because in those retirement years, if your goal is to, jump on a plane and see the world, you don't want to be dealing with emails and tenants and issues, running up a 6 property portfolio. We can have, like you said, part of that growth engine property should be in there if, you're diversified enough, but just be across the lifestyle commitment to running your portfolio. The second thing that I would sort of throw in there that requires some planning, if you're going to pivot your portfolio, managing capital gains tax. One of the great things we've got now is within super, once you're retired, you can put $30,000 into super and claim it as a tax deduction. If you haven't made contributions for the last 5 years, and your balance is less than 500,000, you can accumulate these unused tax deductible contributions. So you might sell a property, have a $150,000 gain, but be able to put $100,000 into super to reduce that capital gain significantly. So with some forward planning, working with your accountant, working with an advisor, really pivoting that portfolio, the cost to do so can be managed and significantly reduced with some forward planning.
Beautiful. And I think that's important. The 5-year carried forward concessional contribution rule may not be around forever, so utilise it when you can. There is also the undeducted contribution limits that you can look to utilise as well. So tax planning is so important heading towards retirement, because if you can get a bit of wealth into more tax incentivised structures like super, then, you're going to be, from a dollar perspective, a bang for your buck perspective, well better off. Because if you've got a large portion of assets in your own name generating income to the day that you die, you'll be paying tax. But if you structure them in the right entity, then you are going to get a better bang for your buck, because you're not going to have this big cost. And often the largest cost that we have while we work is tax. So tax is a major part of a very successful retirement and a very successful pivot as well. Adam, I want to ask you this question. I'm going to ask you this question only because I love my property and I'm an accountant. I also can say I do love shares as well, but shares versus property, I know that it's an age-old debate, and I'm going to ask it just to invoke a bit of passion. What's your primary weapon of choice when it comes to investing? Is it property or is it shares? And I'm not going to let you sit on the fence on this one, my dear friend.
As you know, building wealth accumulation, through the power of leverage, if you put a gun to my head, I have to say property. Because obviously that power of leverage, whilst you can leverage in shares, it's not as common. The volatility of the share market generally scares people. So property generally as a wealth accumulation tool, that would be definitely part of a wealth accumulation plan. Shares too, but if I had to pick one, I'd say property. In retirement, for the reasons that we've discussed, mate, the objective being income generation, I've got to go with the shares because, I collect that dividend, 4.5%, 5% sort of dividend with franking credits without any headache. The liquidity just helps for a more stress-free retirement, and one that just gives me a lot more options around liquidity and income generation. But in saying that, though, if you've got enough wealth, I want you to own a bit of everything. So some property blended with shares, blended with bonds, blended with cash. So I don't say one way is the only way or the best way. But getting off the fence, mate. There's my answers.
Mate, I'm just happy I got a financial planner to say that they like property as part of an accumulation phase, mate. I love it. Thank you very much for today, mate. There's been some really key takeaways. So if you've listened to this on Spotify or iTunes, or you're watching this on our YouTube channel, make sure you rewind it and really get into your mind about that asset allocation at retirement, and making sure that you've got your buckets and the percentage of wealth in the right bucket, achieving the right result. Because I think that's something that not many people do. People just think, I've got this balance, it's accumulated, and I'll draw upon it as I need it. But it doesn't stop when you retire. You still need to make sure that you are making the right decisions to specifically allocate the right amount of funds and the right asset inside those various buckets to achieve a very long-term, very fruitful, very successful, and most importantly, a very happy retirement. Adam, thank you very much for your time, mate. It's been a pleasure joining you in this 3-part series where we've really got to debunk some myths, really provide a lot of valuable content for people to listen to, and hopefully just invoke the idea that these things can be achieved. I specifically really like how people can retire on 100 grand and how easy it is to achieve it if you just have some consistent but smaller actions. I loved insurances and what people need to understand, those little hacks around getting deductions into super for specifically insurances where they're non-deductible, and also making sure that you don't let apathy creep into your life, and ensuring that you are looking at various policies, and most importantly, the type of assets in these buckets that we've discussed about what you need to obtain or what you should be having inside a very balanced and very successful retirement. Adam, thank you very much. You can reach Adam Chalk at fruitionwealth.com.au or reach out to him on his office number. As I've always said, he's always happy for a chat. That's 024623 5566. Adam, thank you very much, mate, for your valuable time over these last 3 episodes. I think a lot of listeners, a lot of viewers are going to get a huge amount of benefit from just looking at what we've just scratched. We've only just scratched the tip of the iceberg. If we had 2 weeks, we could talk about this until the cows come home. Adam, thank you once again.
And thank you, Jeremy. My pleasure, mate.